Good morning, traders. USD JPY is testing critical technical resistance ahead of today's highly anticipated US Non-Farm Payrolls report, if, of course, it changes anything in terms of how the dollar is moving. It has been strengthening aggressively on safe haven flows driven by the escalation conflict in the Middle East, of course, with the Strait of Hormuz closure also threatening a massive global energy shock. Markets are pricing in a higher for longer inflation narrative, higher for longer actually rate interest rates from the Fed as well. That of course favors the greenback over the yen. Meanwhile, despite Japan's recent political shifts, the yen continues to struggle as it completely erases the gains made following the PM Sanai Takaichi's snap election victory. So while the Bank of Japan recently raised its fiscal 2025 growth forecast by 20 basis points, this optimism is fading, and Japan's preliminary Q4 GDP also missed expectations just on Monday. And with Donald Trump's new global tariffs, which are, by the way, facing a massive lawsuit from 24 US states, we're talking about their 15% new global tariff, by the way, they threaten to unravel Japan's export outlook. So the macro double bottom here, following the post-election crash, we have at around the 152 level, has led prices higher. Okay, and we are currently consider this as a false break one and a false break two above the neckline of this double bottom formation. So we are now testing that decline, and the reality is that if we do move above this neckline, okay, let's just not forget we have also a double top here for now. If we do validate the close above that level, then we could be heading up to around 159.50 and then to the 160. But we have very critical and important resistance, a liquidity grab, I would say, at the 158.26, which is the huge candle that USD JPY dumped back on the 23rd of January. Now, let's just look at it from a different perspective a little bit. Let's go a little bit closer here, and I want to show you what price and RSI is telling us. Prices have gone up, okay, in a straight, I wouldn't say straight line, but the reality is that the trend has accelerated. If you look at this base channel initially, right, we have accelerated, and we are now also in the very short term have a double top to take into consideration. So there is some sort of likelihood that we might consolidate in this territory, with the bottom being at 156.44. So this could be like a fractal that in the short term, of course, represents the larger structure, if that makes sense. So if we do break above that level, that could eventually also mean that we might see this happening also here. It would assume, of course, that first we're going to go down, right? So we would assume something like this. Now, talking about this in the short term, of course, means that we also have to mention here what's going on with the RSI. We have tried to reach the previous high at 158, but we didn't get there yet. So far, this price action does not reveal a divergence with the RSI. However, the next leg to the upside, wherever they may be, it might be at 158.26 to be honest, is probably going to provide us with an RSI signal, a divergence. Then we might go down to retest that level, 156.40, perhaps even lower to 155. Okay, because let's not forget, as long as we are outside this channel, okay, this is considered as the last move to the upside. And typically, how do we move? Let me just remind you quickly, we're moving fives. So we'll be looking at something like 1 and 2 here, and 3 and 4, and probably a 5, because this is also typically where we see prices correcting. Internally, of course, we've got another sort of 5-wave structure probably here as well. That would be 1, the 2, the 3, and the 4, and the 5. But regardless, what I'm trying to say here is that there is a high likelihood that we're going to see one more leg to the upside, whether we go first to reclaim that level or not. And this is going to cause to form a divergence. Then we might see a deeper correction and then further continuation to the upside. But one way or another, if we play this as a double bottom neckline breakout, and if we, of course, confirm a valid breakout above this trend line, and just to be a bit more helpful here, a confirmed breakout above that level would mean that we need to see 3 days closed closing above that line. Okay, now this is the height, the distance between the top and the bottom and the neckline top, right? So if we were to look at this in the longer term, essentially we would be looking to replicate that structure or the height of that leg from the breakout level. That brings us to 163.19. So, uh, if this is a medium long term play, you could wait for that correction to initiate. And then, obviously, if we're going to do this, we'll be looking for based on the new high, because I think for now we don't have a peak. We need to see another move to the upside to have a final peak. And it might end up being a diagonal even. Then we'll be looking for opportunities at the previous wave four. Okay, so I will be looking for a swing in a swing term play scenario to trade the 23 correction. After we see an leg to the upside, I repeat, I will be placing my stop below the 38.2, and I will be placing my target initially at the previous high, okay, which is still a very positive trade at 250, and then I will be leaving leaving the rest to the 163 level or whatever that was, with a trailing stop, of course. Now, if you wanna like take a little bit more risk on, and this is of course entirely up to you, I would be looking for a potential double top correction here. That might continue, to be honest. We might see a consolidation here, but I would be looking for a new peak, and I would be looking to short that peak. So I would be looking at a short position at the top with the stop just above the previous high, this high, I would say. Perhaps even we bring it to 158.65, just a little bit above that level. And or to the downside, we'll be looking for the previous wave four, perhaps even the top of 156.81. Either way, this is still a positive trade, but as you can understand, it's not as rewarding as the one we just explained. There is, of course, the bearish scenario, as I was just explaining, in the short term, but there is also the bullish macro breakout, which again, I want to highlight again that if we don't see three consecutive, not consecutive, well, I would say 3 sessions above the 157.65, 3 daily candles above it closing, then there is no confirmed trade yet. Okay, let's also not forget that on the daily we do have more room to move higher, but we are in the middle of the top side, because you've got the 50 equal distance and the 70. Okay, so the question is, are you trading the breakout, or are you fading the double top at 158? Share your thoughts in the comments.